Interesting. Good evening, everybody. This is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am back to talk closed-end funds and overall strategy. I have no idea why the video started blank. I have no idea why Zoom changed its profile and started everything as video not displayed. But updates in technology doesn't always make sense. Um, All right, so the stuff to get out of the way. So this is an unedited video, as you've already seen. Who knows what you'll hear in the background as I film these in my house. I am not a financial advisor. I am a strategist, a financial strategist. And I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So as I debated on how to do this video, I really just thought the best way to go about it would be to plow forward and see what happened. So with full transparency and very little preparation, you get to see how this plays out. Um, I thought about deep diving strategy again, but there's just no cause for it. The market itself is much the same as it's been. There's been a slight change. I'll share some information from Brett Owens with you, um, and then I think give you two versions of how I would do a portfolio. But I would pause the screen and then read it in full, and then process it, and then understand it. So, uh, yeah, you get to see my tabs at the top. Um, of the things that stand out to me, the Fed has lowered the rates again, and on on the macro market side of things, you can argue that it was a non-needed cut. Now, you and I want interest rate cuts because it impacts how everything else works, but the economy overall seems to be fine. So it seems they've lowered rates for no good reason. Now, because of that, the market itself said potential inflation ahead. And I would even say potential, um, man, drawing a blank this early. That's not a good thing. Potential recession ahead is almost how the market at large reacted. But the economy, he says the economy is fine. I would say the economy is still chugging along, snail pacing itself along, not doing great overall. But everything is looking with hope and expectancy of what will happen in about 15 days. So there are jobs. The market's not hurting for liquidity. You know, bonds dropped, which doesn't make a ton of sense. Generally, you get a rate cut and then bond prices go up. But it's that bigger picture at play. The generally in the short term, rates drop, bond prices go up. In the long term, that long term rate acts finicky at times. And this would be one of those times. So bonds are currently despised, and it's been that way. It's been up and down minimally, but bonds have been just not on everybody's favorite list. I honestly don't know if I shared that screen or not. Maybe I didn't. Maybe I told you to pause my screen. Um, so let me move. I don't know if you can see that or not. Pause this screen, read the information, digest it, and then see what you think. Uh, yeah, live video, raw video, you get my mistakes. Uh, bonds have just been despised since really September. I would argue before then, even. It's been the place to be. And we've hit a point where, with the long rate, um, goodness, I'm trying to wrap my bearings again. With the long rate going up and the bond market freaking out even further, bonds dropped even lower. Oh, and that's kind of across the entire market space, that's not exactly what I've seen in our portfolio. Uh, but with bonds slipping lower overall, utilities are slipping a little lower overall. Now, normally I've said we've missed the utility boat. The energy boat was maybe 12 months, 6 months maybe, but really 12 months, 18 months ago. But with bonds dragging lower, utilities are dragging a little lower and the discounts are widening. So since the pricing is down a little, the yields go up a little, but the discounts widening out rep, give us a decent time to still buy bonds, but also to buy utilities as well. And factored into that, it's still just a great time to buy real estate because as despised as bonds are, which is dragging down the utility market a little bit, real estate is just dog. So overall, the strategy hasn't really changed. It's still a bonds and real estate game. It's just since the market overall freaked out, which is what the overall fear and greed index shows as well. I'll share that screen if I can. I mean, the overall index, overall market sentiment, because remember, technology is up, energy as a whole is up, oil and gas is moving higher. Overall, people feel weighed down by whatever the Fed's meddling with and whatever they're pushing, and they're getting pushed away from bonds for whatever reason. And that presents us with a really great opportunity. And Brett talks about that more in his article. It's it's one thing to buy discounts whenever they arise. It's one thing to and target dividends and discounts and put those two together. It's very different when you're buying both in fear and when people just the market overall when the market despises something, like when the market hates on bonds, or when they run in fear of something, and like it's almost untouchable. Like nobody wants to deal with that. It's really hard at times to buy the stuff that nobody else wants, but it gives you an amazing opportunity because you get it at cheaper prices, you get the insane discount, and pending the yield, whether the yield is leveling or maybe a company just had a cut, if you can predict the market well, then you get an increasing yield or an increasing dividend as the company comes back. So bonds, utilities by proxy, and real estate are still where we want to be. So how that looks overall in the master, or how that looks overall for the week, I went through and updated everything, and then moved that off into a separate spreadsheet. So let's look at that. So as we really limit out this list, if we're inside our Roth, then I wouldn't look at municipal bonds. That doesn't really help us. And if we were already invested in utilities, that could be a good option. But adding another fund, like for us, we're of what's on this list, we own everything in dark blue. So real estate, the mix, technology, not the focus right now per se. I think it's still a great long-term play. It's just not the best deal in the current market. Uh, bonds and a mix of things, bonds, but um, I don't want to say limited reach, but it's a smaller company of corporate bonds. And then you have, like, on the other end of things, just a giant company of corporate bonds, plus that private business development lender, almost like a private BDC. So it just fits the bill a little bit better. So I still think bonds are the way to go if they're already in your portfolio. If utilities are in your portfolio, then that gives you a great option. If you've got bonds and utilities, you've got a little more choice. And then real estate is a great option. But me, I would still invest here. But here's how this plays out, because I'm kind of getting ahead of myself. So everything's already targeted, right? We want to focus on monthly income. So then we want to separate it out by yield. Interesting. What happened here? Ah, so strange. So strange. All right. So we look at it by yield. We want to look at 9% or above, unless there's just a really good reason. Like this one is still pretty much 58% off. So you're getting it for 42 cents on the dollar. So everything under in an already established portfolio for on my end of things would just get deleted off. If you haven't opened anything and you were looking for options, utilities are options. I'm not paying that, but I would pay this. Uh, you have municipal bond options pending how your portfolio is structured. Really, all four of those. Let's see. That's utilities. I know the idea behind single stocks and how the US economy is just poised to do well right now. But outside of technology, as tempting as it is to buy a portfolio when it can, I wouldn't do it just yet. And if you do it, I completely understand why. But for me, it's not where just can't explain it. It doesn't fit the current demand of the market. Um, these are newer, or at least they've been on the list, but they're at the top in yield, but we don't own them. I mean, they're great options. Um, but since we don't already own it, I don't want to add into anything else. It's that thing of like if we were already in utilities, then I would consider it. But since we're not, it doesn't make my list. But that's the strategy. And I want to focus on what we're already in, unless it's like a deal that's too amazing to pass up. And if we could really dump a lot of money into it, that might be different. But that's not our position right now. So I would not go with any of these things, and I would keep it to what we already have. But of the list, what would I pick? I would still pick this because it's a bond company. It has that BDC component, and I think that'll be a big angle in the coming market, but really just the coming season with the guy who's coming in to be Treasury Secretary in the overall Trump economy. I think that gives us the best options going forward. Close follow-ups would be all of the above. Now, something that we're having to consider, and all in full transparency, I mean, we are self-directed through Webull. So we have a Roth and then we have an individual cash account. We have an account for Morgan Stanley that's managed by a wealth advisor who has a very different strategy than us. And we've held back on figuring out what to do with that account. But we're at a point where we need to address that because his style of investing is more, I don't want to call it old school investing, but it's more traditional. It's growth of capital through uh, return of investment by um, just overall fund growth as opposed to dividends. And it's growing funds with the goal to reverse dollar cost average. as we sell our principal. And we don't want to do that. We want to focus on growth overall. And we also want to focus on dividend income and retiring or supplementing a retirement through dividends. So we want to restructure that portfolio, meaning we pretty much want to sell everything in that portfolio. So we've been going back and forth with him. So we're going to see how that plays out. But of how I would restructure that portfolio, which is it's not a tax-free account. So we can consider mutual funds, or not mutual funds. We can consider municipal bonds. I've done that twice. Municipal bonds. Um, Closed-end funds are like mutual funds. However, they pay better. Um, Me personally, I like them better. Um, Closed-end funds, you get the actual discount, you get an amazing yield. I like the structure better than a mutual fund, but for whatever reason, every time I try to say municipal bond, I say mutual fund for whatever reason. But if we're gonna take ownership of that portfolio at Morgan Stanley, whether it stays at Morgan Stanley or not, we'll see. Kind of depends on how willing he is to work with us. But if we took it over, this is how I would structure it. It's the same idea, but since it's not a tax-free account, we would buy. Good night. We would. I wish this mouse would work. We would buy municipal bonds. We would also buy utilities, and we would buy some of what we already have. We would buy technology because it is a great time to get into technology. We would buy bonds. We would buy kind of that blended portfolio of bonds and other, and we would buy real estate. And because I think the stuff in blue uh, will do well, it's tilted toward that, and the utilities are uh, not as heavily weighted because I don't know how long we would stay in them. And the municipal bonds are kind of that midpoint, I guess you could say, between the two groups. So this isn't a surety. This isn't fixed in stone. I have quite a bit more research to do on the best options for us in that money and how we would figure things out. But in the short run of what we would do now, and we're not buying tomorrow, but if we were of the options, I would put more into FCO. Um, Guess the close second option. Like if I didn't do that, I would pick BRW or just technology because it is still a great buy looking forward. Um, and I love this company. I do. I love this company. But if I'm going to hyper focus on strategy, as much as real estate is in our options list or in our consideration list, I still think this company presents a much better potential for overall growth and dividend growth in the short run while it's almost like while they're still working the kinks out and waiting for square footage to come online. Um, I mean, honestly, if we can invest in them all, we would. But for right now, if we were buying tomorrow, and we're not, but if we were buying tomorrow, I would put money there. So it's really up to you and your own strategy and what you have in your portfolio. If you can pick up a reasonable size of anything new, and you can ration out or logically process that out with yourself of why that's better than anything in your portfolio, great. If you've already got bonds, real estate, and utilities in your portfolio, and you're kind of picking whatever fits the best for you in that moment. And if your portfolio is one of those three, then it's like the first example. It's in over diversification for diversification's sake is almost like a safety net. It's spreading yourself thin and not allowing your Um, your portfolio will grow where you know it's going to grow. So if you have it in your portfolio, consider it. If it's not in your portfolio, then anything you add has to be better than what's already in your portfolio. Uh, and then it has to fit the strategy. Like oil and tech are amazing, right? Like oil and tech are great, but they don't fit the current metric uh, of what we own. We own these two oil funds, oil and energy funds, and they're great. They're priced higher than what they've been. They still pay decent yields. It's not 9%. They still pay decent yields, uh, but their discounts don't meet the metric. But if for whatever reason it makes sense to you on a dollar cost averaging sense, then that works out well. It's whatever you pick, it's just got to fit your strategy, and you can't change your strategy just so you can pick something different. It's here's the strategy and what fits. And then you keep the strategy until you see that you need to change it, but you're not going to change it just so you can pick up a fund. Uh, but that's really all I got. So it's much the same thing. It's much the same set of companies. It's much the same set of targets: bonds, real estate, and then utilities, just because they're proxies to bonds. And if something changes, I'll update the overall strategy. As I made this video, I was reminded again that I need to make the overall why closed-end funds as opposed to anything else video. And if something happens with our additional portfolio, I'll keep y'all posted. So that's really all I got. I wish you a happy new year. Wish you, I mean, school is starting back for us. So I wish you and your kids another great semester at school. And I hope you have a great week. And that's really about it. So uh, let's see, if you want to comment, throw me a comment. You can come find me on other social media. Uh, and let's see, biggest things I can leave you with. If you don't have a strategy, you need one. And if your current strategy doesn't cut it, never be afraid to change. Never be afraid to adapt. It's always like on our end of things, we are continually studying our strategy and continually sifting through our strategy, making sure that we don't need to make any changes in any random place. So never be afraid to adapt what you're doing, but don't adapt what you're doing um, in order to how do I say this? Just because you want a fund and it doesn't meet the strategy, don't adapt your strategy just so you can get the one fund. That kind of carries over for other stuff. That's your strategy, right? And if you're going to live by that, then that needs to be your strategy. Don't modify it or tweak it just so you can be selfish and do other things. It's just my 2 cents. So hope you have a great week. I will see y'all on another video. Uh, yeah. And if you have questions or comments or feedback, by all means, leave me a comment. So talk to y'all later. Bye bye.